Hey everyone, Chris Versace here, Tematica Research. Today is Tuesday, October 15th. We are coming to you a day later than usual. Yesterday was Indigenous Peoples Day, or some people continue to remember it, Columbus Day, which was kind of a mixed day, if you will. I mean, it was fantastic for the stock market, don't get me wrong. All the major indices moved higher, stretching the valuation on the S&P 500 that much further. But again, yesterday was kind of a mixed day. I say that because a lot of businesses in the U.S. were closed in observance of the holiday, but not all businesses. At the same time, the stock market was open, but the bond market was closed. With today, Tuesday, we can say that a lot of folks are back to work for 4 days of trading, and it's going to be a busy 4 days of trading. Why do we say that? Well, kind of simply, we are starting to see the pace of September quarter earnings really start to accelerate. Last week, we had a couple companies report, a lot of big banks, Wells Fargo, JP Morgan, but now today that is really going to pick up in a considerable manner. We do have earnings today from Bank of America, but also Charles Schwab, Citi, Goldman Sachs, PNC, as well as United Health, JB Hunt, and United Airlines. Earnings season is kicking off, my friends, in a big way. Not only do we have a lot more financial companies, but we're starting to see the types of companies that are reporting really start to widen out. Here's the thing. It's only going to get busier this week, and it's going to get even busier in the following weeks. So my advice for folks is to kind of sit back, pay attention to the customers, the suppliers, the competitors to companies that you might own. That's what we'll be doing here at Tematic as it relates to our thematic strategies and our thematic models. Case in point, what do I mean? Well, this week regarding the CHIPS Act, we have ASML who's going to report. So we'll be curious as to what they have to say about semiconductor capital equipment demand. Are they seeing any benefit from the CHIPS Act here in the U.S.? What about that spending for a similar program in the Eurozone? When it comes to digital infrastructure, we've got Nokia and Ericsson reporting. So we'll be curious to hear what they have to say, not just as it relates to AI, but the impact of AI on digital networks and what that might mean for incremental capital spending. We've also got Taiwan Semiconductor reporting this week. No doubt there's going to be a lot of insight as it relates to our AI models and digital infrastructure models, but we'll also be listening for what they have to say about smartphones, about PCs, and as it ties to our CHIPS Act model, because Taiwan Semiconductor is one of the larger spenders on semiconductor capital equipment. And if their capacity is tightening, like it could be, given the ramp in AI and data center, as well as the rebounds that are underway in PC and smartphone, it could mean that their capital spending levels for the balance of 2024 and into 2025 might be a little higher than previously expected. As it relates to our digital payments model, we've got Discover and American Express reporting this week. What are they seeing in terms of consumer spending, not just in aggregate levels, but where are consumers spending? Is it on travel or not? Are they spending on experiences still, or are they starting to see a shift in where consumers are spending, indicating that there might be greater trade down than previously thought? We'll also have some other companies outside of our models, including CSX and JB Hunt. We like to follow these companies because they help give us a nice bead on the economy. Just think about it that as more things are moving in and around the economy, the faster that pace, the better it is as an economic indicator. Or if we start to see things slow down, that could be a flag that says, the economy might be softening. So we'll look forward to see what CSX and JB Hunt have to say. Now, as we mine all of those data points and think about our thematic models, we do have some pretty key economic data coming at us as well this week. Retail sales for September, industrial production, and housing starts. Retail sales, we'll be leaning into that, not only for what it might tell us about the cash-strapped consumer model that we have, but also the digital lifestyle model, because digital shopping and all that entails is captured in our digital lifestyle model. Regarding housing starts, that's going to be some data that we focus in on for home building and building products. We saw a nice start to pick up to single-family housing starts in the August data. We'll see if that continues. There are companies out there, Lennar, as well as KB Home, that have forecasted a double-digit increase in deliveries in the second half of the year. That kind of suggests that we might see some incremental lift in housing starts in September. But we'll see what the data has to say to us. And as we think about all of this and digest it all, we'll also be paying close attention to what's going on with Israel and Iran. That has been a very positive tailwind for our safety and security model. We'll have to see how Israel strikes back and what the response is. It could lead to even more upside for that safety and security model. But we'll also be paying attention to what's going on with the election, because we've only got a couple of weeks to go, and what the policy implications might be depending on not only who wins the big seat, but the fallout in Congress as well. And what I would say, folks, is as we're navigating this week and thinking about all of these things, we'll also be mindful about the market. Why? Well, its valuation is even more stretched after yesterday's move higher. And we have noticed that consensus EPS for the S&P 500 in the second half of this year has continued to move down. As of last Friday, the second half of the year was only expected to grow about 6% compared to the first half of the year. That's down from more than 11% in July. In other words, the market has continued to move higher. Earnings growth has come down. That means the market is incrementally that much more expensive. At the same time, the S&P 500 is moving ever closer to its RSI level of 70. If it crosses that, classic sign that it is overbought. And investor sentiment has rebounded and now sits inside of, yes, extreme greed. Those are three factors that you're going to want to walk the prudent path in the market. You might even want to consider using our market hedge model. That's it for this week. Be sure to look back for more signals as it relates to our thematic models. We've got some below, and we'll have more on Thursday. These are the rip from the headlines confirmation points for our strategies. I think it's some pretty interesting, sometimes entertaining reading. I hope you enjoy them. Thanks for watching.